Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. In today's video, we are going to be speaking about a very important aspect of trading. And this is something that I think a lot of people think that they know a lot about, or at least they think they know just about enough for them to get on with their day-to-day trading. But it's crucial for us to break this down together so you know how we can use different aspects of trading, in this specific case, the spreads, in our favor on a day-to-day or weekly or monthly trades that we end up taking. So this video is not an introduction of what spreads are. I'm not actually going to be going through, the bid line and the ask line and what the spreads actually show, so on and so forth. You can all get that information from just a simple Google search. Today, I want to talk about how we can see spreads differently in a buy position versus a sell position, and how you can actually use that to your advantage when it comes to trading. So if you get value from this video, make sure to press the like button down below. If you're new to this channel, press the subscribe button. Welcome to the family, welcome to our community. So let's go ahead and jump straight into it. First things first, I am not affiliated with any brokers. I don't do any broker referrals or anything like that. And the reason why I have always been hesitant in recommending brokers is because there is not one broker that everyone around the world would be able to use. It really does depend on your trading style and different things that you want from the broker, such as, let's say, the asset classes that you want to trade, or your deposit and withdrawal methods, and most importantly, your country of residence. So I'm not going to be recommending any brokers, but what I can do is mention the name of the brokers that I have used. IC Markets being one of them. The reason why we enjoy trading with IC Markets is because this was one of the brokers that we found it very easy to deposit and withdraw, and the spreads that they were giving us on their raw spread accounts was very good. Very low spreads, allowing us to be able to execute with very small stop losses. But again, this is not a recommendation. You are the person who has complete responsibility to research different brokers properly, to understand whether or not they even provide services to your country of residence, whether or not the broker suits you, and more importantly, whether or not it's going to be a broker that you want to trust with your capital. You are the person who's completely responsible with all of the risks associated in this industry with different brokers. So for the purposes of this training, I have opened a random demo account with Hugo's Way, and the reason I opened it with Hugo's Way and not IC Markets is just so we can see the spreads a little bit easier. Again, this isn't a training on what exactly the spreads are. Please do your own research. It's very easy to figure out exactly what spreads are. This is a training for you to understand how spreads will affect your trading. So whenever you look at the quote section on MetaTrader 4, you can always see the value of spread under the currency pair. For example, at the top for AUD USD is now saying the spread is 14, and that is 1.4 pips or 1.3 pips. So normally the spreads are in terms of pipettes. So this is simply stating that whenever you are executing a trade on AUD USD, chances are the value of your actual entry, the price of your actual entry, is going to be 1.3, 1.4 pips different to where you have analyzed your charts on. Now, this actually brings me to the next point, which is also very important. It's not just that your broker is important, the data feed you analyze the charts on is also important. So let's say on TradingView, you're analyzing charts and you're using the Oanda data feed, and you end up using a broker that the actual values are, significantly different to what you see on the charts. This doesn't normally happen that massively in foreign exchange. This could happen a lot in cryptocurrencies or some other asset classes, but it could take place in foreign exchange as well, that you see a certain price on TradingView, but when you look at your actual brokers, the price is nowhere close to what you see on TradingView. So long as the price is close enough, it's all right. We don't really care about it too much, if I want to be honest with you. But what I'm trying to say is that it's important to understand that it's your MetaTrader 4, what you see on your actual broker, that's going to either make you money or lose money. So sometimes you might need to adjust your stop losses. For example, make them slightly bigger or put them at slightly different values to take into account your actual broker price. Personally, I analyze my charts on TradingView, mostly using the FXCM data feed. Sometimes I would use the Forex.com data feed as well, as these data feeds have very close prices to the brokers that we use. If you analyze your charts on MetaTrader 4, that's a whole different story. That's actually a step better, let's say, because technically speaking, you're analyzing the data on the actual data feed that you're going to be trading it on. So there's not going to be a big difference in price anymore. The reason I don't use MetaTrader 4 on my laptop to analyze charts is simply user interface. I really like how TradingView gives me so many options to be able to make my charts look nicer. Let me put it that way. So let's get to the first major nugget in this video. Spreads matter in a sell position a lot more than they do in a buy position. I'm going to repeat that one more time. In a sell position, spreads can manipulate you out of your trades, whereas that can never happen in a buy position. And let me explain to you exactly what I mean. So let's have a look at the chart section over here. You should be able to see two lines on the actual chart section on your MetaTrader 4. If not, go to your settings section, click on charts, and make sure your ask price line is ticked. So if I want to get technical with the terminology, the red line is what we call the ask line, and that's the price that you will buy the market at. And the blue line is what we call the bid line, and that's the price that you will sell the market at. So if I click on trade and click on buy by market right now, and quickly go back to the charts, you can see that that buy position was executed at that red line. And whenever you execute a trade, you always see that instantly it's in drawdown. That's normally your spreads and the commissions or the charges that you're paying for the broker. For you to now break even on this trade, this market needs to come higher and the blue line needs to go above where you bought it at. In a way, the blue line needs to reach where the red line was when you purchased the market. So if this continues to come higher and higher and higher and higher, then eventually we will be break even and maybe in profit. Now, another thing to take into account when it comes to spreads is that the bid line is the line that will tell you the actual price of the market or where the actual candle is. So the blue line, in a way, this line down here, this blue line always tells you where the actual price right now is. So the actual ask line or the red line, this is the real spread. This is the line that sometimes ends up increasing back and forth, going up and down. Sometimes you might have seen that whenever there's a new daily candle formed, normally at 10 p.m. UK time or 5 p.m. Eastern, their spreads all of a sudden go crazy. These two lines all of a sudden get very far from each other, and that's the time that a lot of people can get manipulated out of their trades. So it's important to remember that it's the ask line or the red line that's going to increase or decrease. That is the real line of your spread. So that's that in regards to the buy position. Obviously, I will be breaking this down a little bit more as well. But a sell position is going to be executed at the blue line or at that bid line. So if I go ahead and click trade and click sell by market, you can see that that sell position was executed again at the blue line, not the red line. And for this to now be break even, this red line needs to come lower and cross below the sell point. Meaning what? The market has to drop enough for it to account for spread and be enough in profit. Now, this is slightly annoying because technically the bigger the spreads, the worse your entries, and the bigger the spreads, the bigger your stop losses. So this is one of the points that we always have to take into account to have brokers that allow us to have small spreads. There's different account types that different brokers allow you to have. Normally the account types would fall under a standard account or a true ECN or a raw spread account. Standard accounts are the accounts that normally you do not pay any commission per every trade you execute to the broker. However, you will have to deal with slightly bigger stop losses because the spreads are going to be larger. You're not paying any commissions to the broker, so they have to, in a way, make back their money somewhere. So the spreads end up increasing. The raw spread or true ECN accounts, these are accounts that you will pay commission per every trade that you execute. It depends on the broker how much the commission is. Normally, it's around $5 or $5 to $7, I'm going to say, per every standard lot. But now, because you are paying commission per every trade that you execute, your spreads are going to be tiny. And that is what I would prefer. I would prefer to pay commissions and have smaller spreads, because on the scale of things, especially when you start to use much larger lot sizes, it would be a lot more cost effective to actually pay commissions to have smaller spreads and therefore smaller stop losses. Now, here's what we're going to do. We're going to go ahead and sell this again. And this time I'm going to put the stop loss at 0.96 0.9622. So 0.9622, sell by market. That's where the sell position has taken place now, again, at the blue line, and our stop loss is over here. Within a sell position, the actual price of the market does not have to reach your stop loss for you to be taken out of this trade. So in a sell position, it's enough for this red line or for the ask line or for the spreads to increase ever so slightly and take you out of the trade. So if this market now goes a little bit higher, you will see that it doesn't actually need to reach all the way up there. The actual price of the market being the line down here, it does not need to reach our stop loss all the way up here. The spread in itself will take us out of the trade. This is now a little bit dangerous because we have to massively take into account the spreads, especially when it comes to sell positions. For example, let's say you have a trade open and it's hovering around entry area and is coming close to the daily close or the daily new candle being formed. All of a sudden the spreads increase massively. Or for example, you're keeping a sell position open throughout a major news, and sometimes you will see during major news the spreads increase massively. So that's also another dangerous point, because if you're still in the trade and it's hovering around entry point and you're selling it and a major news is coming out, the market doesn't even have to go against you for you to be taken out of the trade. The spreads can all of a sudden increase by a few pips and boom, you're taken out of the trade, gone. Now this cannot happen in a buy position. So let's go ahead and buy this now, and we're going to put our stop losses, for example, at 9604. 9604. Now, this is now our buy position where, again, it was executed at the red line, not the blue line. In a buy position, it would be the actual price of the market or the blue line, the bid line, for it to reach your stop loss before you are taken out of your trade. Remember, we said that it's the red line that's the spread. It's the red line that all of a sudden can increase and go up and down. The blue line will stay the same. That's the price of the market, right? So the blue line will move if there is major move in the market, simple as that. It's the red line that can be very indecisive. I'm going to say all of a sudden increasing in spread or decreasing in spread. So now in a buy position, it really doesn't matter whether the spreads get increased massively by few pips or it gets smaller. It will never reach down here for it to manipulate us out of the trade. Why? Because the red line or the ask line cannot cross below the blue line or the bid line. Now, this is a very major point when it comes to trading with small stop losses, because I know in a buy position, spreads can never manipulate me out. In a buy position, I will be taken out of the trade and I will hit stop loss if the actual price of the market reaches my stop loss. So if I'm completely wrong in my trade and the value of the actual market comes below and boom, it hits my stop loss and it takes me out. Whereas in a sell position, again, to recap very quickly, in a sell position, let's say 0.9619, 0.9619. In a sell position, it doesn't have to be the actual price of the market. It's enough for the ask line or for the red line to increase quickly in spread and boom, we are taken out of our trades. So you have probably seen examples of this in the past where, you know, you're in certain trades and the actual price of the market has not reached your stop losses, yet you have been taken out of the trade. Now you know why that is. And now you know if you want to sell a currency pair with a very small stop loss, you have to allow an extra few pips for your spreads. Or it might not have to be an extra few pips. It depends on your broker. Let's say if you're trading Euro USD and the spread is, 0 or 1 pipette, then you don't obviously need to add another 2 to 3 pips to your spreads. A little bit extra would do. Now, this does not mean that whenever we want to have small stop losses and insane risk to rewards, we will be buying the market. No, that's definitely not the case. But based on these spreads, it makes it a little bit easier for us to be on the bullish side of the market if you want to have smaller stop losses. Again, if you have true ECN or raw spread accounts, because the spreads naturally for the major pairs that we trade are quite low, it doesn't make that big a difference for the buy position or a sell position, but it's still important to take these things into account. So it would be a good idea before executing any trades, quickly check the quote section, see how many pips the spreads are. Remember that the value that's shown there, again, depends on the actual asset class that you're looking at. But for Forex pairs, normally that's in terms of pipettes, not pips. So again, the spread for AUD USD at the very top is 1.5 pips or 15 pipettes. it would be a good practice to keep an eye on these spreads before you are executing a trade, and if need be, allow a little bit of a bigger stop loss just so you are not taken out of your trade when the price of the market doesn't even reach your stop loss. Now, this also gives us another advantage in buy positions as well. There have been scenarios that I have bought the market and the market has come very close to the stop loss and ended up reversing and going in the desired direction. That's a bit of a peace of mind for me for the buy positions, because I would know that even if the market comes this close to my stop loss, let's say my stop loss is here, 0.96065, and let's say, yeah, it's only 5 pipettes away from my stop loss, it's still not going to actually manipulate me out of the trade unless the price of the market touches my exact stop loss. And I know I'm saying this for the third time, but it's important for you to remember this. This is not the same in a sell position. If it comes that close to the stop loss, if the spreads in itself are half a pip, then it's definitely going to take you out. Now, I didn't want this video to be very long. I just wanted to quickly give a major tip for spreads for institutional traders, or for that matter, for any trader out there, whatever strategy you're using, whatever school of thought you're following, for you to know that to be successful in this industry, there's a little bit more to it than what strategy you use. There's a little bit more to it than, even having a good mindset. There are different elements that you need to know about to protect yourself against certain manipulations. At the end of the day, capital preservation is something that's important in trading. I'm not saying never risk your capital. Well, risk it at your own will, but you have to know how to keep your hard-earned capital safe. So remember what we spoke about today, the differences between a buy position and a sell position in terms of the spreads. Also remembering to check the spreads before you execute a trade and not execute a trade when the spreads are massive, or if you want to account for the spreads, which will in turn affect your actual risk per position. And what I mean by that is if your stop loss is 10 pips, but the spreads in itself is, let's say, 5 pips, then you have to calculate your risk based on a 15 pip stop loss, not a 10 pip stop loss, and calculate your lot sizes accordingly. In due time, we will actually speak about how to get good risk to rewards and how to have confidence executing with small stop losses. But all of those are conversation for another day. So if you got value from this video, press the like button down below. If you're new, press the subscribe button. And shout out to everyone who's utilizing the videos in this channel, as in you're watching them, rewatching them, practicing them, and putting the necessary hours. So many of you have sent me messages on Instagram showing me the trades that you have caught or the milestones that you have achieved in your journey, different amounts of money that you have made in a week or a month or whatever it may be based on the stuff that we have shared over here. So I'm super proud of everyone who's put in the work in. But with that being said, as usual, let's elevate and let's catch some pips.